morning, my name is Brendan, here with my partners Henrik and James. Today we're going to be looking at the financial performance of GreenTech Innovations from 2024 to 2025. Our financial analysis will be based on liquidity, debt, and profitability ratios, as well as a horizontal and vertical analysis. We're then going to conclude with forward-looking recommendations that will allow GreenTech to expand their operations and increase their market share. We're going to start with our liquidity ratios, first taking a look at our current ratio, which includes assets such as cash, accounts receivable, inventory, and prepaid expenses. We can see it went from 1.73 to 1.98 in 2025, meaning GreenTech improved their ability to pay off current liabilities with current assets. We can then take a look at our quick ratio, which excludes assets such as inventory and prepaid expenses because they're not as liquid as cash and accounts receivable. We can see it went from 0.79 to 1 in 2025, and this means that GreenTech reached 1-to-1 coverage of their immediate liabilities. Overall, it shows that GreenTech is improving liquid assets without relying too heavily on things like prepaid expenses and inventory. Next, we'll take a look at our debt ratios, first starting with our debt to asset ratio. We can see it went from 0.44 to 0.41 in 2025, and this means that debt represents 41% of assets in GreenTech. In other words, for every $1 of assets GreenTech has, they owe 41 cents to outside creditors. And this improvement shows that GreenTech is now becoming less leveraged, and lower leverage indicates higher financial stability. Next, we'll take a look at our debt to equity ratio, which we can see went from 0.78 to 0.69 in 2025. This means that for every $1 of equity in the company, they owe 69 cents to outside creditors. And although this doesn't seem great, we can see in 2024 it was 0.78, meaning that outside creditors had a larger hold on the company. But now GreenTech is moving towards stronger internal financing rather than relying too heavily on borrowed funds. And finally, we'll take a look at our profitability ratios. We can see our gross margin did decrease from 27.67% to 26% in 2025, meaning that production costs rose faster than sales. But our operating margins stayed pretty consistent around that 17 to 18% mark, showing consistent control over operating expenses. Our return on assets improved from 9.2% to 10.67%, meaning that GreenTech was able to generate more income per dollar of assets they own. And our return on equity increased from 16.36% to 18.06%, meaning that shareholders are going to be receiving larger returns on their investments. Overall, GreenTech grew profitability while maintaining operational discipline.
If we take a look at the horizontal analysis, we can see that revenue increased by 25%, showing that GreenTech captured more customers or increased its overall sales volume. But at the same time, we can see that cost of goods sold increased by 27.88%, rising faster than the revenue. This explains why margins decreased instead of just a higher material, labor, or production cost. Even so, gross profit increased by 17.47%, meaning that GreenTech still generated more absolute profit in order to support its operations. And operating income rose by 20.37%, showing a strong operating discipline. Even with rising production costs, GreenTech kept its operating expenses under control and managed to increase its earnings from core activities. Cash increased by 133.33%, which is a major improvement. This growth supports liquidity, reduces risk, and allows for more flexibility in strategic spending. Accounts receivable increased by 49.19%, aligning with their higher sales volume. This increase is healthy as long as GreenTech keeps collecting their accounts receivable efficiently. Inventory rose by 34.08%, indicating that GreenTech is preparing for higher demand or scaling operations. And total current assets increased by 44.79%, showing a strong expansion in working capital. Overall, total assets increased by 3.93%, showing that GreenTech is growing, but doing so without becoming overly invested in long-term assets. This allows GreenTech to have a more balanced and flexible asset structure. For liabilities and equities, accounts payable increased by 24.62% and accrued liabilities by 27.96%. This aligns with their larger scaling operations and are completely normal when a company starts to purchase more goods and labor. Total long-term liabilities decreased by 13.33%, showing that GreenTech is intentionally lowering its debt obligation, reducing its improving its long-term solvency, and reducing its interest burden. Total equity increased by 9.09%, reflecting the 100% increase in retained earnings, and increasing equity allows for more financial security as well as supports future growth. Overall, GreenTech is scaling its operations responsibly, balancing growth with reduced financial risk.
Now let's take a look at our vertical analysis. First, we can see that total liabilities decreased from 43.68% to 40.89%, meaning GreenTech is relying less on borrowed funds as a financing source. Next, we can see that total equity increased from 56.32% to 59.11%, showing that profits reinvested and owners' equity is increasingly becoming the primary foundation of the business. Overall, these trends suggest that GreenTech is developing a stronger equity base, which lowers financial risk, improves borrowing capacity, and enhances long-term capital flexibility. Continuing our vertical analysis, but now on the asset side, we can see that total current assets increased from 20.22% to 28.16%, meaning the company is becoming more liquid and more capable of funding operations using short-term resources. Next, we can see that total property, plant, and equipment decreased from 79.78% to 71.84%, meaning GreenTech is relying less on heavy fixed assets and transitioning toward an asset-light operating model. After analyzing, we can see the concentration of short-term assets is increasing while the concentration of long-term assets is decreasing, which allows GreenTech to pivot faster, scale production more efficiently, and avoid being locked into high maintenance or depreciation costs. From last year to this year, GreenTech Innovation shows clear improvement in 3 key areas. Firstly, revenue strengthened, indicating growing demand and expanded sales activity. Profitability improved as well, showing the company is becoming more effective at turning operations into earnings. And finally, liquidity is stronger, meaning the company is better positioned to meet short-term obligations and maintain financial stability during a downturn. Altogether, these trends show steady progress and a healthier foundation for future growth. Now looking forward, we can use our analyses along with insight from the early stages of Sunrun, an already successful solar panel company that's gone from startup to over $3 billion market cap, to understand what GreenTech Innovation should do going forward in order to expand their business. Firstly, we recommend continuing to strengthen liquidity. What this can look like is maintaining a current ratio from 2 to 2.2 to balance liquidity with capital efficiency, as well as making sure any excess idle cash is strategically deployed into growth initiatives rather than sitting unproductive. Next, to improve cash flow, we recommend reducing short-term debt obligations, which would make our operations more stable. To optimize inventory, given inventory grew 34% while revenue only grew 25%, we recommend implementing demand forecasting and tighter inventory turnover targets to prevent working capital drag. In addition, we can expand our market reach by increasing marketing, which would help us scale, similarly to how Sunrun expanded nationally before they IPO'd. And lastly, using Sunrun as a model, we know Sunrun's early stage expansion was supported by aggressive market penetration and capital infusion prior to IPO. GreenTech should replicate this by pursuing private equity financing to scale distribution before considering their own public offering. All in all, if GreenTech executes disciplined capital allocation, cost control, and strategic expansion, the company is better positioned to transition from a regional growth firm to scalable national competitor.
Thank you.